Okay. So leverage ratio, I'll just quickly explain it again.
Okay.
See, leverage means with 1 rupee. See, you can take the example of, as I said, rental basis. So when you stay on rental basis with 10,000 rupees rent, you are getting exposure to your home worth maybe like, let's say 20 lakhs. Okay. Similarly, in share market, let's say you are spending 40 rupees and you are getting exposure to product worth 100 rupees. This is called leveraged trade. Leveraged trade means basically borrowed, you are trading with borrowed money. Borrowed money, trading with borrowed money. Okay, trading with borrowed money. Okay, that is leveraged trading. In short, leverage means borrowed money. It is also called as margin trading. Margin trading. Okay, margin trading or leveraged trading. So what we are learning is with 1 rupee, uh, for what product or what is the value of the product for which I will get exposure to. So if I say for 40 rupees, I'm getting the product worth 100. So I want to know for 1 rupee, okay, for 1 rupee, what will be the value of the underlying assets. So now you cross multiply. So when you cross multiply, you will get 100 by 40. Okay, so 100 by 40 becomes 2.5. So this x is nothing but leveraged ratio. This is called leveraged ratio. That means with 1 rupee, I am getting exposure to the product worth 2.5. Okay, this is okay.
Yes.
Yes, sir.
Okay, should I do this sum again?
No, sir, I got it.
No, got it,
100.
sir.
Okay, yeah. So leverage trade means with 1 rupee, you can trade for what amount? Because in the cash market, ideally, in the cash market means equity market, with 1 rupee you can trade for 1 rupee asset only. With 100 rupee you can trade for 100 rupee assets. But over here within the cash market, there is one segment called margin trading, where here the leverage can differ. Okay, broker to broker, how much leverage they are giving, it can differ. But in this case, it is 2.5. That means with 1 rupee you can trade for the product worth 2.5. That's what it means. Okay, and then we did all this. You should also know the heading execution instructions. So under execution instructions, under execution instructions, we have market order, limit order, and then standing limit order. Limit orders waiting to execute. Standing limit orders. Uh, standing limit orders, and then all or nothing order, hidden orders. Okay, hidden order, it is also called iceberg order. Okay, then validity instructions. So under validity instructions, validity instructions, day order, valid when till when the instruction is valid for that day, or good till cancel, GTC, good till cancel. Then immediate or cancel, immediate or cancel, fill or kill, good on close, good on close. Then market on close, then good on open, then stop orders. Okay, so we'll just give one word to it so that it is easier to remember. So this one is based on the best market price. This is based on the best market price. This is based on the price quoted. Based on the price quoted. Then standing limit order means waiting to be executed. Limit orders waiting to execute. Limit orders waiting to execute. All or nothing. So all or nothing, whole order can be filled. Execute only if whole order can be filled. Execute the whole order or nothing. Hidden order, uh, useful for large deals. Then day order. Day order is valid only for that day. valid only for that day. Good till cancel means valid until the order is filled. Immediate or cancel. Orders are cancelled if they are not filled immediately. Fill or kill. No, both are same only. Right. Then go down close. Go down close. Orders are only filled at the end of the trading day. Orders are only filled at the end of the trading day. Market on close means orders at the end placed based on the uh, closing prices. Orders that are referred to as market on close. So I can write this as market order at the end of the day. Market order at the end of the day. Here go down open. Uh, so here orders are only filled at the beginning of the day. Go down open. Then stop order. This is stop loss and stop buy. Stop loss and stop buy. So stop buy is for short selling, and stop, this is to stop the loss after buying. Okay, so these are all very important one. Also some other keywords like take the market, make the market. Okay, some other keywords are uh, take the market, then make the market. Okay, then make the new market. Okay, then behind the market and far behind the market and far behind the market, right? Behind the market. Okay. So make the new market means new price between the best buy and best sell price. Behind the market means uh, order price after the best one, or rest of the order price after the best one, rest of the order price after the best one. Okay. Then take the market means placing order matching with the best price. Matching with the best price. That is, you take the market. Then make the market means now here how are the traders who post bid and offers are set to make a market. This is initial one. Trader who post bids and offers are set to make a market. So make a market. Traders who uh, post bid and offers. That is to make the market. Okay. So this is very important one. That's why I was quickly summarizing like this. Okay, it is very important one, and you will get like maybe one or two questions from this for sure in the exam. Okay. Now next one. So from here we are supposed to continue. So primary capital market, all this you just see. You want me to explain anything? Primary market, remember we did primary market, capital market, day one, that one only, all this.
Yes.
Yeah. Then uh, the Innovation Bank finds investors who agree to buy part of the issue. They are not actual orders but are offered to us indications of interest. Okay. So this is about IPO now. So on day one, I told like this that Cafe Coffee Day has become a brand. Now they are going to the public and they are issuing shares. But they know only to make coffee. When they know only to make coffee, how to raise capital, they have no idea. So what will they do? They will go to the Innovation Bank. Now the Innovation Bank, which is taking the responsibility, it is called as underwriter. Underwriter. Now, first of all, so they will study the company's balance sheet, income statement, and also they will do the roadshow. Roadshow means basically marketing. So marketing means what? They will have meetings with prospective buyers like mutual funds, pension funds, big institutional investors, and and try to seek their interest, like if they are interested if CCD comes into the market or not. Okay, that is called indications of interest. Then book building method. Now, what is book building? See, book building means when they are pricing the issue, it can be priced in two ways. One is called fixed price issue. Fixed price. Fixed price means, let's say, for example, the price of one share is 100. That's it. If you are okay, you buy. If you are not okay, you don't buy. Okay, so there is nothing, no change. That is fixed price. Second one is called as book building measure. Book building. So, okay, so book building. Uh, so book building means what here? In under book building, a range will be given to the investors. For example, they will give the range 100 to 110. 100 to 110. Within this, any price you can quote 100 to 110. Okay, any price investors may quote. Now you may think that okay, if any price has to be quoted, which price will you select then? 100, 101, 102, 105, 108, 109, 110. Investors will select what? 100 only. Normally, that's what you will think that then they will go for the lowest price, but it doesn't happen like that. If this company is really good, if this issue is really good, maximum people will go for what? 110. Okay, in the application form there will be one word as cutoff. Cutoff spelling is, yeah, cutoff. Okay, so cutoff. So they will select cutoff. That means they are okay with any price. Whatever be the cutoff price, they are ready to pay. That means even 110 also they are ready to pay. So that means basically they are seeing the demand in the market. So they will begin with obviously 110. So if at the rate of 110, if they are getting enough money, then all others will be rejected. Whoever quoted 109, 107, 100, all will be rejected. So that's why if you are quoting very low, 100, then your probability to get the IPO also goes down highly. And if you are selecting high price, then your probability to get the IPO also goes up. So that's why many people go for cutoff or they quote higher prices. Okay, that is book building issue. Then book runner. Book runner means this underwriter is only called as book runner. These are different names. Book runner. Okay. Yeah. Then the best efforts. Underwritten offering and best efforts. Now underwritten offering and best effort means, now underwritten means they are taking the guarantee. Underwritten means investment bank is taking the guarantee and then they are saying, so underwritten what will happen is, here is the company. Now they will buy it from the company and then they will resell it back to the investors. Okay, at the higher price. They will buy it and then they will resell it back to the investors at the higher price. That is underwriting. Another one is, so normally they will get commission like 1 to 5% of the issue. So if it is 1,000 crores, then you calculate 1% to 5%, any amount depending upon the negotiations between them, they will charge. Okay. Now another one is best effort. Under best effort basis. Under best effort basis, see, imagine suppose it's a government company. Now when it is a government company knows the moment I come into the market, I have, imagine this is LIC. So LIC may think that I'm a government company, I have a huge brand name. The moment I come into the market, everybody will be interested in my company shares. So why should I pay high commission to these investment banks? So they will say, look, investment bank, you don't take up any guarantee because I have enough demand, so there is nothing to worry. Okay, so so what will happen is, uh, So what will happen is, um, this LIC or government bank will say, look, you just do it on best effort basis. Best effort means what? Best effort means this investment bank just will do the work of all documentation work with the regulators. Okay, so that documents point of view, rules point of view, nothing is pending. And then once it hits the market, automatically demand will come up. Why? Because it is all government company or some branded company, government company or big branded company. Imagine something like Tata, or Ambani companies. All these are branded, right? So automatically the curiosity will be built up. Okay, that is best effort basis. Okay, yeah. Then private placement. Private placement means raising capital privately without going to the public. That is called private placement. Okay, raising capital privately without going to the public is called private placement. Okay, so privately you can issue shares also. Privately you can issue debt as well. Okay, then shelf registration. In a shelf registration, your firm makes its public disclosure as in a regular offering, but then issues the registered securities over time. That means, uh, have you heard about Muthoot Finance Company?
Yes, sir.
What do they do? Muthoot Finance Company? No idea.
Gold.
Yeah, they provide gold loans. So they provide gold loans. That means if you take your gold to them, okay, they will give you loans. Now the question is, who is giving money to them? How are they getting money to give loans? Are they like a bank? Are they taking money from the public deposits, anything fixed deposits or saving account? Can you open with Muthoot Finance saving account? You cannot open saving account with Muthoot Finance, right? Then how are they getting money? So what happens is they keep issuing bond. Okay, they keep issuing bonds. So when they keep issuing bonds, every now and then, after every few minutes, you will see them issuing bonds. So every time they cannot go to the regulator and keep on taking permission, fully filling up all the formalities, documentation, all that thing. That will be time consuming. So they will take permission once and that will be valid for few years. That is called shelf registration. Okay, self registration. Permission is taken once and then that is valid for few years, and then accordingly they will keep coming into the market again and again, and then they will keep uh, issuing bonds, and then they will keep raising money from the public. That money only is given to the borrower, some other borrower as loan. Okay, so shelf registration means they register for this bond issuance with the regulator once, but they will again and again keep coming into the market on that basis, and then they will keep raising money from the from public. Okay, the next one, dividend reinvestment plan, allows existing shareholders to use their dividends to buy new shares from the firm at a slight discount. So this kind of uh, facilities I have not seen in India, but they have given here. It is there for mutual funds in India, but this I have not seen anywhere for shares. In mutual funds, whatever mutual funds you are supposed to get, you can buy units on that basis. Okay, but you cannot buy shares here. Okay, you can buy units, but in US because you in US it is traded on decimal basis. You can buy 1.2 shares also, 1.5 shares also. Whereas over here that is not possible. You will have to buy 1 shares, 2 shares, 3 shares, like this. Whereas over there, even in decimal you can buy. Okay. Yeah. So that is dividend reinvestment plan. That means with the dividend also they will buy shares. Okay. Next one is rights offering. Rights offering means what? Rights offering means uh, rights issue. Okay. Any idea what is rights issue? Rights issue? No idea. Rights issue. See, rights issue means raising capital from the existing investors of the company. Okay. So initially IPO is getting issued, right? And after that, imagine 5 years down the line, 10 years down the line, imagine this company wants to again raise capital. Now, this is already a public listed company. Okay. This is already a public listed company. Now, 5 years down the line, they want to again raise capital, maybe for something like 500 crores. Now they don't want to again see if they raise second, if they go to the market and again issue shares and raise capital, it is called as FPO. FPO means follow on public offer. Follow on public offer. Okay, follow on public offer. Okay. Yeah. So 500 crores, imagine. So that is follow on public offer, but the company doesn't want to do all that thing. Company says, I will go only to my existing shareholders and raise capital. So if they go to the existing shareholders and raise capital, then it is called as rights issue. Rights issue. So rights issue means what? Raising capital from the existing shareholders. From the existing shareholders of the company. From the existing shareholders of the company at a discounted price. Why are they raising capital at the discounted price? Generally around 25 percentage discount is given. Why so? See, imagine in the stock exchange, this is the stock exchange. Now, this is an existing company. So already it is being traded at 100. So if this company is issuing at 120, will anybody buy? No, right? Why? Because in the market it is available at 100. Why would somebody buy from this company at 120? 120 is not possible. If they sell at 100, will anybody buy? Maybe yes, maybe no also. Why? Because there is nothing attractive. Already in the market is available at 100. Why should I use all this different facility? As usual, I can go to the market and buy at 100. So there is no guarantee that people will show interest at 100. And also imagine they are issuing at 100 and suddenly Trump tweets something and this in the market the price comes to 95. Now what is attractive? This market price is attractive. So why would people come and pay 100 here? Again, it will be failed. So now, so that's why what they will do is they will give, they will sell at 70, they will sell this as at 75. So that in the market it is 100. So that even because of Trump's tweet or anything, if the price comes to 90 also, still people should come to this company for buying at 75 here only. This should be attractive than the stock exchange. So that's why rights issues are issued at discount from the face value. Generally around 20-25% discount is given. Okay. Then next one, This part all you can ignore. Okay, this part is not needed. Basically, continuous must just shortly I'll tell you. Continuous market means like continuously you can buy and sell when the market is open, like hours from 9:15 to 3:30 you can continuously buy and sell. Okay, that is continuous market. Call market means only at specific times it will be traded. I have not seen anywhere as such, maybe in some underdeveloped countries if it is happening or what, maybe, but otherwise it is all continuous market only. Okay, that price is traders trades occur at any time when the market is open. Okay. Then there are three main categories of securities market. Okay, code driven market where investors trade with dealers, order driven market where rules are used to match buyer and seller, and brokered market where investors use brokers to locate a counterparty. Okay, so quote driven market. So example, see this video also, quote and order driven market, I have made a video. I'll just send that one. 1 second, wait. 1 minute. Yeah, I have sent the video, quote and order driven market. Later on, you may watch that, and now also I'll explain it to you. See, order driven means whatever you are seeing in the exchange, those are all order driven market. That means, wait, I'll just show this to you. Like if I take you to nseindia.com, okay, so here, uh, if I take Reliance, see this is bid and ask. Now it is empty because now the market is not open. But otherwise, tomorrow if you see, you will be able to see this. Bid price, best bid, best ask, all those things. This is called order driven market because everybody is placing order. Buyer is also placing his order and seller is also placing his order. That's why it is called order driven market. So what is the example of order driven market? Stock exchange. Stock exchange is the example of order driven market. Okay, order driven market, this one. Now in order driven market, we'll come to code driven in a while, uh, in which, what is the hierarchy that is followed. So the order matching rules, first priority is given to, okay, so here how it works is, first priority is given to price. That means for the buyer, highest price, and for the seller, lowest price. Okay, that is the priority. So whoever is quoting the highest price, he will come to the top for buying. Whoever is quoting the lowest price, he will come to the top for selling. That is first priority will be given. Okay, so first priority will be given to the price. After that, second priority, when the deal has to take place, based on the price, it will match. Second priority is if price is matching, then it will give priority to time. I mean, imagine two people quoting the same price, then it will give priority to time. Okay. Then third priority is the hidden orders. This is an important one. Okay. Hidden order. What do you mean by hidden orders? Remember, I told about this display order, display iceberg order. That
Yes.
will get the last attention or last priority to match the trade. Okay. Yeah. Then so order matching rules, price priority. Then after that, secondary preference given to non-hidden orders. Non-hidden earliest order. That means time. Okay, earliest order means time, and after that, finally, hidden orders will get the price. Okay, yeah, that's the point here. Then code driven. Example of code driven is, so these are all for order driven. Code driven is quote driven. A very simple example, if I say unofficial one, you are going to a shop. When you are going to a shop, that is also a market only. Na? There is buy and sell. But when you are going to a shop and you are buying a biscuit for 10 rupees, the shopkeeper has already fixed the price of biscuit for 10 rupees. You cannot go there and put your order that okay, I'm ready to buy at 5 rupees. You cannot put your order. Price is already fixed. Now you decide whether you want to buy or not. So such market is called as what? Quote driven market. This quote is driving. If people like this 10 rupees, they will buy. If not, they will not buy. But they cannot bargain and change the price. That is called quote driven market. It's something very unofficially example I'm giving you. But little better, more professional example is something like simple example which you can relate is, imagine you are going to a bank, and in the bank it is mentioned like this: $1 is 85 rupees. Okay, $1 is 85 rupees. When you are, they are ready to buy at 85 and they are ready to sell at 86. Now the price is already fixed. The question is, you decide whether you are okay with this price to buy and sell or not. You cannot go and keep bargaining there. Okay, that is called quote driven market. Similarly, the largest quote driven market is Nasdaq. It is in US. Okay, quote driven market, Nasdaq. So Nasdaq has Nasdaq. It's a quote driven market. OTC market also. OTC means over the counter. Okay, what do you mean by over the counter now? Over the counter means without the presence of the exchange. Okay, without the presence of the exchange, uh, you know, without the presence of the exchange itself, it has grown up highly. Okay, Nasdaq, Nasdaq here, all IT companies are traded. Okay, IT companies price is fixed, and at that price, people will buy and sell. So that's why it is a quote-driven market. Nasdaq is a quote-driven market. Okay, so stock exchange is an order-driven market. Nasdaq okay, stock exchange is an example of order-driven market. Nasdaq is an example of quote-driven market, where over-the-counter trade takes place. Over-the-counter means direct, buyer and seller will know each other directly. They are buying and selling without the stock exchange. third one is broker. So broker to broker, broker to broker, like real estate. Real estate is a brokered market, right? Broker only know each other. Okay, so similarly, for all illiquid securities, brokered market takes place. So security that is unique and illiquid. When the trader has a security that is unique or illiquid. Examples are large blocks of stock, real estate, artwork. Okay. Then this all you can ignore, doesn't matter. Uh, Pre-trade transparent, post-trade transparent, doesn't matter. This is all you can ignore. Okay. Post-trade transparent, if investors can obtain post-trade information regarding completed trade prices and sizes. Pre-trade transparent means before the trade itself, if investors can obtain pre-trade information regarding quotes and order. Okay. That means before the trade itself, you are getting the information. Here after the trade, you are getting the information. That is basic stuff. Now some other theory: operationally efficient and informationally efficient. When will the market, your market is operationally efficient, operation wise. Operationally, it will be efficient when the cost is low. So operational efficient means trading cost is low. Then it is operationally efficient, right? Trading cost is low. Then yeah, okay, low commissions, beta spread is low. Okay, so then it is operationally efficient. Quickly, if you want to buy and sell, you will do it. You don't have to think much. Informationally efficient means what? Informationally efficient means if security price reflects all information associated with the fundamental value in a timely fashion, then the financial system is informationally efficient. So informationally efficient. Informationally efficient means if security price is reflecting all the information. If security is reflecting all the prices. Then allocationally efficient. Informationally efficient market, capital is allocated to its most productive use. That is called allocationally efficient. Allocationally efficient means allocating capital to the most efficient project or most efficient security. Okay. Allocationally efficient. That means allocating capital to the most efficient project or assets. Okay. Then SRO means self-regulatory organizations. Okay, self-regulatory organization, they will not ask this one. I think maybe only one question might be there in the website. Self-regulatory organization means self-regulatory organization. Example, our self-regulatory organization is stock exchanges, BSC and NSC. They are self-regulatory. That means self-regulate. They themselves will regulate their broker, because SEBI cannot keep doing everything, right? So they will give some work to some other institutions also. So that is self-regulated. They are making them independent. That you regulate. Okay. Just that these are the conditions you should stick to while regulating that way. Okay. Are you people doing this module quiz? I have not seen you people asking doubts and all. Shravani, are you doing all these module quizzes before this?
No, sir, I will do it from today.
Please do the module quiz. See, this is just one part of the training. All this training. The second part is all about quizzes. Only in quizzes you will learn more, and in fact you will learn much better in quizzes only, because quizzes only will have twist. Okay, and quizzes is the one which will put you down, and from there only you will get more confidence also, because you will grow stronger from there. This is just to make you feel good that okay, we are just doing some training, some terminology, something we are going through, because there is no twist here, right? I'm just simplifying things and explaining, but you will learn when you see the complicated sums. Okay, so that's why if you are not registered, go to the curriculum, and then start solving the questions directly. You don't have to read anything in curriculum, just directly solve module quizzes there. Okay, solve these module quizzes also, and then directly go to the curriculum and solve module quizzes there. And then wherever you go wrong and whatever doubts you want to discuss, you bring it here, we will discuss. Okay, yeah, these are all the key concept, means it's a summary. Okay, so you can read this as well. Okay, now security market indices. Security market index is used to represent performance of one asset class security market. That means basically index, Nifty 50, Sensex. These are all index. Okay, security market index, and they constitute securities, means what it consists of. It consists of IT stocks, banking stocks, auto stocks, FMCG stocks. Okay, together all constitutes an index. Now, uh, return index. An index return may be calculated using a price index or a return index. A price index uses only the prices of the constituent securities in the return calculation. A rate of return that is calculated based on a price index is price return. Okay, you will know price return again sometime. This part, if you ignore this part, is also fine. You will learn this part better only when you get questions from the curriculum. Okay, easy only, but you will learn because there is no sum mentioned here. Proper sum is not mentioned. Okay. Hmm. So this part you just or shortly I'll explain this, but you will still learn only when you get me questions from the curriculum. See what it means is here, RP is equal to 1 plus RS1, 1 plus RS2. Okay. 1 plus RS1, 1 plus RS2, 1 plus RS3. Okay. Hmm. Uh, yeah, this part is not required. We'll just do this one. See, if the returns for first two periods, are 0.5 percentage and 1.04 percentage. They would geometrically linked to produce 1.55 percentage. See, for example, you know geometric mean. Have you done geometric mean before? Geometric mean, do you remember? Geometric mean means,
Multiplication thing, right?
yeah, yeah, okay. Uh, that is there in actually another subject in quantitative methods. I have to talk about all these things. Uh, Geometric mean is not required actually now. Um, okay, but just shortly I'll explain. See, geometric mean means, see, for example, what is arithmetic mean? First of all, arithmetic mean is arithmetic mean is, let's say, uh, first year 10 percentage return, second year 15 percentage return, uh, third year 12 percentage return. You will add, divide by 3, it will give you arithmetic return. Okay, just calculate this, just add all these and divide by 3. 10 plus 15 plus 12 divide by 3.
12.33.
12.3 percentage.
12.33.
12.33 percentage. Now if I want to calculate the geometric mean, how I should calculate, so this is first year return 10 percentage, then second year return 15 percentage, third year return 12 percentage. Geometric mean will be, 1 plus, I will think like what will 1 reach to? 10 percentage into 1 plus, so it is like this: 1 plus return 1 into 1 plus return 2, that way, into 1 plus 12 percentage, 1 plus R3. Okay, now this is for 3 years. So just multiply all this, calculate.
It's 1.4168.
Okay, 1.4168.
68.
So this is for 3 years. I want to shrink it to 1 year. So what I will do, I will do raised to 1 by 3. Okay, raised to 1 by 3. So how do I solve this one now? Acha, I have not told Shravani how to use calci here. Okay, let me just tell you how to use this calci. Acha, because Subhajit would know this, but I'm not sure if you know how to use calci to calculate all this. See, this is the calculator you have, right? Okay, this one,
Yes, sir.
how you should calculate, in this one. First is 10%, 1 plus 10 percentage. You start from the ending, it will help you in other complicated sums. That means this one, 10 percentage plus 1. So 10 percentage plus 1 equal to, okay, 1.10. Keep it in store 1. Store is memory. See this one, store 1. When you do this, you will not find any changes on the screen, but it has been stored. If you want to check that one, you clear this. This is to clear. Now this is recall. RCL 1, that is recall. So when you recall, you will get back that number. Clear? Recall 1 will get back that number. Okay, so that number is already stored. Now next one is 15 percentage plus 1. So 15 percentage plus 1 equal to, that is 1.15. This is store 2. Store 2. It is stored in memory 2. Clear? If you want, you check this. Recall 2, and if you want recall 1, it is here. Okay. Then similarly, third one, 12 percentage. So 1 plus 12 percentage. No? So 12 percentage plus 1 equal to. So keep it in store 3. Have you done till here? Just try.
Yes, sir.
Okay, done. Now see, I want to multiply all this, right? So I will do recall 1 into recall 2 into recall 3 equal to 1.42. So this is 1 point. Acha, why I'm getting 1.42 and here 1.4168 is acha, okay. What you are supposed to do is, okay, first we have to change this. You have only 2 decimal, right, in your calculator?
Yes, sir.
Yeah. Actually, it should be changed to 8 or 9 decimal. Okay, we will do that also now, but let it be now 1.42. Then raised to 1 by 3, we want to shrink it. This is for 3 years, we want to shrink it to 1 year. That's why we are doing 1 by 3 inverse. Okay, it is 1 by n. N is 3 years here. We are shrinking it to 1. So now you do this. First of all, 1 by 3 you do. 1 divided, no, 1.42 we got, right? Did we store that one? No. 1.42 we got, no? Keep it in store 4. Store 4. Recall 4. Done?
Yes, sir.
Recall 4. Now 1 by 3. Let's store this as well. 1 divided by 3 equal to 0.33. Keep it in store 5. Or you can keep it in store 6, 7, 8, 9, whichever is convenient for you. Okay. Store 5. Now I need these two numbers only. For store, recall 4 and recall 5. So recall 4 raised to, this is raised to, y raised to x. Can you see? Y raised to x. Okay, y raised to x. Um, recall 5 will give me 1.12, 12 percentage. 1.12, are you getting 1.12?
Yes, sir. Got it.
Okay, so this is raised to 1 by 3, that is equal to 1.12. Now, what do you mean by this 1.12? 1.12 means it says, remember we started the story with 1 only. So 1 is growing at 10 percentage, 1 is growing at 15 percentage, 1 is growing at 12 percentage. So here it is telling us that 1 will reach to 1.12. If 1 will reach to 1.12, but I want to, find out for percentage. So I want percentage. So what I will do, I will do minus 1. Minus 1. When I will do minus 1, I will get 0.12. And I want to include 100. So I will multiply by 100. So it will become 12 percentage. Okay, this is 12 percentage. Subhajit, are you speaking something?
Oh, sorry, sir. Please.
Huh. Huh. Okay. 12 percentage. Have you understood this one?
Yes, sir. Got it.
Okay, 12 percentage. Now, so because we have taken, this decimal, I mean, we have taken only two decimal, it is not very accurate. What you do, now let's change the decimal. Click on this clear work. So you also do along with me. How to change this decimal is, see this format we should use. Can you see this format is mentioned? See, normally if I click, any number, you see this one, 2, 4. Now, but we, above every number, you see something is written here. Data, stat, depreciation, 4 percentage. You can see.
Yes.
So, you want to activate this format here. So when you want to activate format, what you should do, that means that upper part, if you want to activate, you should click on this second, and then you click on this dot, the upper one will get activated, format. Okay, that format, it says that currently it is in decimal 2 decimal, but I want how many decimal? I want 9 decimal. Imagine I want 9, so I type 9 and enter. 9 decimal. I think I'll keep 8 decimal. Okay, 8 decimal and then enter. That's it. Then clear work. So I have 8 decimal now. Is it okay?
Yes, sir.
Okay.
Got it.
Now you try, you will get little more accurate one. So that means 10 percentage plus 1 equal to, keep it in store 1, clear work. Then 15 percentage plus 1 equal to, keep it in store 2. Then 12 percentage plus 1 equal to store 3. And then recall 1 into recall 2 into recall 3. So see this 1.4168 now. You got, no? Okay, keep it in store 4. Then 1 divided by 3. Keep it in store 5. Then recall 4 raised to recall 5. Just practice it quickly. 12 point, and then minus 1 we should do. So 12.31 percentage. Just try once quickly and let me know if you face any problem.
Yes, sir. Got it.
Geometric mean. Now, if I'm doing this only for, only imagine this is first quarter. First quarter's return is 2 percentage. Second quarter's return is 3 percentage. Okay. Third quarter's return is 1 percentage. And fourth quarter's return is 0.5 percentage. That means this is overall what? 1 year only. Now, if I have to calculate the geometric mean, how will I calculate? It will be 1 plus 2 percentage into 1 plus 3 percentage into 1 plus 1 percentage. Just 1 minute. Oops. 1 plus 2 percentage, 1 plus, no, what did I write here? Acha, this I have to calculate, right? Okay. 1 plus 2 percentage into 1 plus 3 percentage into 1 plus 1 percentage into 1 plus 0.5 percentage. That's it. I will not do 1 by 4 here because already it is indicating per annum only. Then minus 1. Okay. Just calculate it now. So this step is not required. If it is within 1 year, if they ask. If they ask for more than 1 year, then only I will do 1 by n. Is it okay? Done?
11.42.
Okay, so 11.42. Shravani, you are able to find it out?
Yes, sir.
Okay, fine. This is what it is. See here, they have given first 2 periods. So first 2 periods, how will you do now? So it is not like 2 years. If the returns are first 2 periods, they would be geometrically be linked to. So 1 plus 0.5 percentage into 1 plus 1.04 percentage. That's it. So they have not done raise to because it is within 1 year. Okay. Within 1 year, or overall, if you want to do the returns also, you don't want to, because you don't want to annualize. First one we have annualized. Generally we annualize, but if it is within 1 year, we don't annualize. Just calculate this. Done? Not done yet.
It's 0.90%. Is it?
Oh, okay. I think that is my mistake. No, 1.04. No, they mentioned 1.55 percentage.
Okay. Okay, so it was 1.1 plus 1.04%.
Yeah, yeah, yeah.
The first one is 1 plus 0.5%. Right?
Yes, yes.
Okay, so I have 1. I made a mistake.
Shravani, you got it?
Yes, sir.
Yeah. Okay, then. Price weighted. This is a very important page. Okay, price weighted index. Very, very important page. You will get one question from this price weighted index. But first, we will do the sum, then we will come to the theory. Price weighted index. See, this is price weighting. Sums are very simple only, but it's the theory that you need to read. So, sum. Just go through this question, then I'll do the sum. Okay. See, basically, how do we find out uh, index is value. Okay, like for example, or should I tell you about our index first? Uh, uh, Otherwise, our index, like I'll stick to this one only, price. Our index, I'll tell you next time. So here, index, like we have Nifty is an index, Sensex is an index. Similarly, abroad also we have other indices. Okay, the there is there is one index called Dow Jones in US. It is also called DJIA. That means Dow Jones Industrial Average. These are two technical analysts. Respecting them, this index were formed. This index was formed. Dow Jones Industrial Average. This index is popular in US. Now, how the price changes here? That's what it is. How it is calculated. Okay, they follow price weighted return. Price weighted. Sorry, not price weighted return. Price weighted index. Price weighted index. Okay. Then, like here, Nifty, Nifty 50, Sensex, okay, or S&P 500. That is in US. They follow market capitalization weighted index. Market capitalization weighted index. Okay, then yeah. Now let's focus on price weighted index now. How to calculate this index? Just go through this question. Okay, so see this here. How do I calculate price weighted index return? Price weighted index. So sum is very simple. All I need to do is just take the average. So this is the price X, Y, Z and 10, 20, 60. Okay, and this is P0, that means opening price. P1 is 20, 15 and 40. 20, 15 and 40. Okay, so here, how do I calculate? All I need to do here is take the average price. Take the average 10, 20, 60. What is the average?
30.
30. And here, what is the average? 20, 15, 40.
25.
25.
25. That means 30 has become 25. So if 30 has become 25, all we have to do is closing price divided by opening price minus 1.
25 by
So
30.
25 minus 30 minus 1. And then multiply by 100 to convert it into percentage. How much it comes to?
16.67. Negative. Yeah.
Negative. Okay. This is it. This is price weighted index.
Ah,
That means here only the price is focused on, not the not the number of shares. Only the price is focused on. Okay. Now what is the drawback of this one? Okay, the drawback is what say for example, uh, the drawback is, or else, let it be now, let it be. Drawback we'll see later. Now this is how we are supposed to do price weighted index. Okay, then after this sum, there is another one, adjusting a price weighted index for stock split. If okay, what do you mean by stock split? I need to explain, right? Okay, stock split. Fine. So stock split also I need to explain. No? Okay, stock split. That will take time. Stock split. We will then stop here only. So what I will do, next time, tomorrow I will start from here only, price weighted index, and then I'll explain. Okay, from price weighted index I'll explain. Fine, we'll stop now here. It's almost 10 o'clock now.
Okay,
Okay,
sir.
okay, yeah, okay.
Thank you, sir.
Okay,
Bye.
okay, bye, bye,
Okay, sir.
bye.
Thank you.
Okay, bye.